Hello everyone, and welcome to this new video about the stock market for beginners. Today we're going to cover the basics of the stock market, so that this concept no longer holds any secrets for you. First of all, we'll answer the why question. Then we'll see what the stock market is and how we can invest in it. And finally, we'll tackle the where question before wrapping up the video with a quick review. So, let's get started and answer why you should choose the stock market. Simply because it's one of the best investments out there. In fact, here you can see a chart comparing the historical returns of different investment instruments. And as we can see, the top performer is stocks with dividends followed by stocks without dividends. Then bonds generate a good return, followed closely by real estate and gold. This chart is from 1920. And we can see that the last century, stocks generated the best return. Let's see if we compare the average annual yield of different investment instruments. Stocks have generated an average return of almost 11% per year since 1975. It's followed by real estate, which usually gives around 8% per year, and then by gold and bonds, which both average about 5% per year. Inflation sits at around 3%. And savings accounts at 2%. It means that if you leave your money in a savings account, you're actually losing money because inflation is higher. Thus, prices are rising faster than what your money can earn for you. It's crucial to protect your capital by investing. Let's now see what the stock market is. The stock market is where investors buy and sell shares of companies. For example, you can buy shares of Apple, Nvidia, LVMH, or Bank of America. Basically, any company listed on a stock exchange. But what's the purpose of the stock market? It allows companies looking for money to connect with investors who want to invest. These investors can be retail investors, banks, or investment companies. Investors purchase stocks, so they give their money to companies. And in return, companies pay them dividends, which means they share a part of their profits with their investors. There are two ways to earn money in the stock market. The first one is through the appreciation of the stock. For example, in this chart, we can see how the stock price has sharply increased over the years. In this case, it went up by almost 370%. The second way is through dividends. By holding a stock, you earn a share of the company's profits. On top of that, you can benefit from compound interest as those dividends get reinvested and help grow your money exponentially over time. Alright, let's see how powerful compound interest can be. If we open TradingView and search for AT&T, a company known for its high dividend payouts, and click on See Overview, we'll get all the information about the company. What we're interested in is the financial information, so I click on Financials. And here we can see that the dividend is around 4.24% per year. If we click on it, we can check the dividend history, which reached almost 7.5% in 2018 and 8% in 2021. Today, the dividend is lower than in previous years, but 4% is still pretty high for a company. So, let's assume this company pays 4% dividend per year. If we simulate this 4% dividend return on the investor.gov website by using the compound interest calculator, and let's say your initial investment is $10,000, you don't add any money every month, and you plan to leave it invested for your retirement, let's say 50 years, with an estimated interest rate of 4%. This 4% gets reinvested annually. Now, let's calculate the result. Here, in orange, you can see your equity curve. Notice that exponential shape? It means the longer you stay invested, the more money you make just from dividends. Your $10,000 have become $70,000. If we simulate over 100 years, we'll see the same incredible exponential curve. Our 10K have become 500K. And keep in mind, this return comes only from dividends. It doesn't even include the appreciation of the stock price. Okay, let's see why compound interest allows you to earn such a large amount of money. If we take our example with an initial investment of $10,000 and a dividend yield of 4% per year, let's see what happens. The 4% is calculated on your initial investment, which means you earn $400 at the end of year 1. That means your capital now becomes $10,400. In year 2, the dividends are calculated on this new capital, so instead of earning $400 again, you earn $416 just from dividends. And at the end of year 2, your capital becomes $10,816. As you can see, even though it's the same percentage, over time you earn more because the amount it's applied to keeps growing. If we move to year 50, your dividends would be around $2,732. And remember, you didn't do anything special. You just reinvested the dividends into the stock. That's the power of compound interest. There's one great investor who truly understood the magic of compound interest, and that's Warren Buffett. Here, we can see his net worth as a function of his age. He once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." And as we can see, there's that same exponential shape in the curve of his net worth. Now, let's look at a different case. The bond market, which is a very complementary market to the stock market. The bond market is where investors buy and sell debt securities issued by governments and companies, earning interest over time. So, on one side, you have companies and governments, and on the other side, you have investors. These investors can purchase bonds, and in exchange, the government or company will pay them an annual coupon rate. Let's break that down a bit. For example, the United States needs money for things like defense, Social Security, schools, and a lot of other reasons. Investors have that money, so the U.S. government offers to borrow it, and in exchange, they give them a 10-year Treasury bond, for example. This bond allows investors to earn what we call a bond rate, which is around 3% per year. At maturity, so after 10 years, because it's a 10-year bond, the investor gets their money back. It's a lot less risky than stocks, but you also earn a little less. All right, so now we're going to answer the how question with 5 important points. First, invest as early as possible to take advantage of the power of compound interest. Second, don't try to beat the market. Be the market by using DCA, which stands for dollar cost averaging. That means investing a small amount of money each month, no matter what. Third, fear is your enemy. You have to invest without fear and focus on long-term profits. Fourth, you don't need to be a Harvard graduate to win in the stock market. It's actually much simpler than people think. And finally, don't do stock picking. Buy all stocks through ETF, so you're sure to never miss an opportunity and to be the market. The final important question is where we can access to the stock market. So first, let me introduce the primary and secondary markets. The primary market is where companies raise capital through the initial offering securities. These securities are purchased for the first time, and the money goes straight to the company's capital. Then you have the secondary market. This is where those existing securities that were generated in the primary market are traded between investors. In this market, investors and traders try to make money through the appreciation of the stock and the dividends it pays. In this market, the law of supply and demand is dominant. Now, let's talk about a very important part of the stock market: exchanges. Exchanges exist all around the world, as you can see here, and all U.S. companies are listed on U.S. exchanges. In the United States, there are several exchanges like the New York Stock Exchange, where Coca-Cola is listed, for example. There is also the NASDAQ, where most big tech companies are listed, such as Apple. In Canada, companies are listed in the Toronto Stock Exchange. There are also the London Stock Exchange for English companies, and Euronext for many European companies. Other very important stock exchanges include the Hong Kong Stock Exchange and the Shenzhen Stock Exchange in China, the Tokyo Stock Exchange in Japan, the Mumbai Stock Exchange in India, and the Australian Securities Exchange for Australian companies. These are some of the biggest exchanges in the world. But you can be sure that almost every country has its own stock exchange. And that's the place where shares of local companies are listed, bought, and sold. Here are a list of major stock exchanges in the world, which are sorted by market cap. We can see that the American market is by far the largest in the world with more than 60 trillion USD. Then it's followed by Shanghai, Japan, India, Europe, and so on. But as a retail investor, it's very difficult to access these exchanges directly. That's where brokers come in. A broker is a financial intermediary that facilitates the buying and selling of financial assets, such as stocks and bonds, on behalf of clients. Basically, you place an order with your broker to buy a stock, and they handle the transaction for you on the stock exchange. Some of the best brokers in the world include Interactive Brokers, Saxo Bank, TD Ameritrade, DeGiro, eToro, and Fidelity Investments. I've selected brokers that are available in more than 200 countries worldwide. If you live in India, in Europe, or in USA, you can open an account with them. Alright, so once you've chosen your broker, you'll need to open what we call an investment account. There are different types of accounts you can use to buy and sell stocks, but the most common one is a brokerage account. It's an individual account that lets you buy and sell stocks freely. The advantages are that there's no deposit limit, and you can withdraw your money whenever you want. The downside is that you don't get any tax benefits. It means you'll be taxed on your profits according to the tax laws of your country. So, make sure you do your own research to understand what tax obligations apply to you. So if we summarize the investment process, you're a retail investor who wants to buy a stock. To do that, you'll open a brokerage account, which is managed by a broker. This broker is your way to access the stock exchange. The broker will send all your orders to the stock exchange, where tons of different companies are listed. And once your order goes through, the stocks are officially owned by you. Let's wrap up this video with a quick review. First, you have to know that stocks are the best long-term investment. Then, by holding a stock, you become eligible to receive dividends, which is a great passive income. The sooner you start, the better it is to take advantage of compound interest. Remember that exponential equity curve we talked about. And finally, always invest through regulated brokers. It's really important. Alright guys, thanks a lot for watching this video, and I'll see you soon for the next one, where we'll talk about different types of portfolios.